Don't forget to start recording.
Thanks, Herb. All right, well, welcome everybody to the December 1st edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by Ken Kavula, my friend to the snowy north. Ken, are you back yet, or are you still on your phone call? Sounds like he's still on his phone call. We're also joined here by Kim Butcher, who is currently residing in sunny Central Florida by way of
Southern Florida.
Southern Florida, even better, right? Can you?
Well, it's 63, just like Herb said. We got the cold front.
Yeah, I think we could all handle a cold front of that magnitude and that sort of thing. All right, so this week we did take a week off for Thanksgiving, so we do want to at least backdate a very warm, happy Thanksgiving to everybody. I hope everybody had a safe and filling Thanksgiving holiday weekend. And we're back at it today. I thought we would spend a little bit of time with Tin Cup and actually walk everybody through the decision process that is used every single month at Tin Cup, and we'll actually do that live here this afternoon. And then, again, we want to keep it fairly brief today because we do have a session, a round table tonight. If you're not familiar with the round table, it's people getting together to share stock analysis and take care of a portfolio that is now over 10 years old and has an 18% annualized rate of return. So it's been a lot of fun. And so most of us will be there tonight. We are going to also talk about monkeys who throw darts, and that explains the guy in the middle of the screen at the bottom. And we'll do some questions and talk about some of our favorite books. But I did want to take a moment and just celebrate that great golf movie, Tin Cup. That's one of the reasons that the Tin Cup demonstration or model portfolio has its name. The other has to do with Warren Buffett and his Tin Cup on a street corner. But we give equal emphasis around here to Kevin Costner and perhaps even more equal emphasis to Rene Rousseau from that movie. If you're a golfer and you haven't seen it, you should. If you're breathing, you should probably see it. It's a great movie. That shot on the far left is after Kevin knocks it in from, I want to say 270 yards out on a famous hole at the U.S. Open, which would have been a double eagle if it weren't for the 7 shots he hit in the water hazard before that particular shot. It's a great movie. Sorry for the spoiler. Check it out. Ken is back.
I am back.
So that gives you some idea about how we think about Tin Cup, and I certainly prefer the Rene Rousseau version of the stories you hear about the Tin Cup portfolio. All right. And by the way, just to be warned, Ken, I'm going to refer to both of us as monkeys here in a few minutes.
All right, I can deal with it.
All right. Here's our regular slide. No investment recommendation is intended by the stuff that we do here. This is an educational demonstration. It is all about illustrating and demonstrating, and we really do like the word demonstrating, the philosophies, methods, and techniques of the modern investment club movement as promulgated by the National Association of Investors, or Better Investing, or Manifest Investing. We're basically trying to take the lessons learned over 8 decades and put them at your fingertips. That's what we're working on continuously. That's what tonight's program is about. The views expressed are our own. Please do your own homework. If we own a particular stock, we do attempt to disclose that. Like I said, the roundtable for November actually snuck into December, the 1st of December this year, but the November roundtable is tonight. And it's a monthly program. It's a monthly webcast going back to 2010. And if you'd like a reminder about that, or if you have friends or family members who would like to have a reminder, and again, it's free and intended to be a demonstration, an educational demonstration, send an email to nkavula1@comcast.net, or you can go to the betterinvesting.org webpage, drill down into the Mid-Michigan chapter, and you can sign up there, self-service. you have any follow-up questions or you would like copies of slides or anything like that, send an email to markr@manifestinvesting.com, especially if you have questions or topics for future sessions. All right, just a quick review. We've been doing this for a few months now. We're not tired of it. We hope you're not tired of it. We try to get together for a few minutes to show, just basically discuss some of the stuff that's going on. This week, we're going to cover Tin Cup, our demonstration or model portfolio at Manifest Investing. Then we're going to talk about dart tossing monkeys and share some favorite books along the way, along with a couple of questions that have come in from you guys. We do plan on covering the topics that are shown there, and if you have a topic or a question that you'd like to pose and get covered, just send an email to us, and we'd be happy to field that. Any comments or questions, Ken?
No, our list is getting pretty nice here, but again, I'm just urging you to send your topics to us. We don't know what interests you a lot of times until you tell us, and a lot of times what's interesting to you is extremely interesting to us as well. So drop us that line. Tell us what you want us to talk about. We'd be glad to move in that direction.
Okay. Well, let's talk for just a minute about Tin Cup. This has been a lot of fun. This dates all the way back to 1994. The importance of it, and it's something that I think you can share with people who are interested in getting started investing, is it's a simulation, but what it does is basically takes the maximum amount that an individual could invest in a 401k plan, pretends or assumes that it could have been invested in stocks during that entire time frame, because more often than not, you can invest in stocks at your 401k, and they just don't tell you about it because they don't like it to be so complicated. They'd rather just sell you those 18 funds that they're offering. So basically, we've been putting the maximum amount into a 401k since 1994 and just watching it grow. Every month, we share the decisions on the Manifest website, and you can see the results there. The blue is the total assets in this particular demonstration portfolio. We topped 3 million during October and closed out the month at approximately 3,250,000. And it's been a pretty good run here over the last several months, a little bit of volatility over the last 2 years. And I say that with sugarcoating because that's a significant amount of volatility. You can see all that blue stuff opening up between the white dots. The red dot is if you had just simply taken and invested that same amount into an index fund featuring the Wilshire 5000. So you can see that that also would have done well, but I think most of us believe that it's prudent to reach for that difference. There are no guarantees that you will achieve that difference. Again, we're going to talk about the type of decisions we make, in the modern investment club movement when faced with this kind of an opportunity. But again, no guarantees, but still that red line's not bad either. And by the way, this little uptick on the far right that you see here, that's the biggest monthly gain in the last 30 years. It's not even really easy to see on there, but it's the biggest monthly gain, at least in the last 30 years when I look back. Any comments on that, Ken?
Well, anytime, Mark, you can do a demonstration over this length of time and show that the money is more than doubling, I think is valuable to people that are taking a look at it. What I find so interesting, and I've been following Tin Cup for maybe 25 years, what I find so interesting is that it requires very little maintenance to it. I mean, occasionally there's a stock added, occasionally there's a stock dropped, but the reasons are always pretty clear cut and pretty straightforward. And I have a hunch that's where you're going next in our discussion. Am I right?
We're going to try to go for straightforward. We'll do our best, but you're right. There actually are multiple years on this chart where not a single stock was sold. And I would say probably more than half the years. I should go back and look that up sometime. There's been a little more selling of late, and in fact, that's a characteristic of a market like the one that we have now, that you can actually be nudged into more selling considerations than average conditions. And that certainly has been the case. But you're right; it's been a fairly mechanical approach to this thing over the years, and it certainly is an attempt to deploy the lessons that George Nicholson has been teaching us for over 80 years.
Well, I will tell you, Mark, that in 2004, I was able to convert most of my 403B money into an IRA, a traditional self-directed IRA, from myself and my wife. And our return over the 30 some odd years that I was teaching in the 403B was really pretty dismal. But since the time I've been able to manage my own money from using Manifest and using the same kind of ideas that Tin Cup uses, I've been able to almost triple my money in that period of time. And I find that to be kind of heartening, especially since my measurement includes withdrawals for various things. And I'm just measuring cash flow at the end of each year to measure my gain or loss.
Yeah, I remember those days about 12 years ago very well when you were shuffling your assets around, and I will admit to being quite envious that you were doing that at that point in time, because it was a good time to be shuffling. All right, so let's go ahead and talk about what's actually in Tin Cup. This is a listing of the current holdings, and we're going to go live and actually work on this dashboard here in a minute. But this is a dashboard showing the key features, and I have sorted this dashboard from the highest return forecast to the lowest. In other words, on the far right-hand side, that return forecast is abbreviated projected annual return, or PAR. So in most investment clubs who manage off of a dashboard like this, the companies that merit a challenge or a sell consideration are at the bottom. The stuff down here with the lower return forecasts, lower potential for price appreciation and or dividends. And the ones up at the top are the ones more likely to be in the buy zone of a stock selection guide. Axos Financial is the old bank of the internet. I am 99% sure that Cy Lynch will present that tonight at the round table. I'm actually thinking about MDC Holdings for another horse race with Ken, because he's going to go with DR Horton tonight. So MDC is another home builder, and I'll study that a little bit and perhaps bring that tonight. And there's one other one that was on our short list for the best small companies this year that I'm thinking about, but it may be home builder versus home builder tonight. But you can see from top to bottom, there are some household names. There are some fairly frisky names on the list. There have been a number of companies that have been extremely rewarding over the years. And again, a whole lot of fun. Here's that run for the roses between Ken and me. Great Southern checks in at 64, and First Financial checks in at 56. They're both doing well. My horse is doing slightly better so far. All right, so let's go ahead and demonstrate. Notice that we have at the end of November, approximately $3,000 in cash. Let's go ahead and switch into the account.
Okay, Mark, before you move from here, I use Tin Cup as a teaching tool as well. And a question that I get an awful lot that maybe is a good one to ask right now is, do you pay any attention to the projected PE column on your stocks that you hold in Cup? I notice, for example, that currently 4, maybe 5 of them have PEs in the high 40s or low 50s. Does that bother you at all? And do you take into account those high PE values on some of these stocks?
Yeah, they bother me. Anytime a PE is 30, 40, 50, or 60, it's going to be something that, quote unquote, bothers me. I don't allow it to interfere with the ownership of a stock, though, because it is just one piece of the puzzle. And what you'll find in most of these companies, EPAM may be the exception here, because that's just been a red hot company that has been doing their own paychecks imitation for years. Paychex is a company that had a PE in the 40s, 50s, and 60s for a couple of decades, and we thought it could last forever. Well, it didn't, but for right now, EPAM's pretty high. But the other ones, Tencent, Amazon, and even Align Technology, these are all relatively young emerging companies where the PEs can be really kind of skewed in the early part of a company life cycle. So I just give that a nod. Notice that so many of the others, I had not noticed this before, so many of the other projected PEs are in the 8, 9, and 10 range.
Yeah, it's a tale of two cities when you look at this list here. You have an awful lot at the one extreme and a whole bunch of them at the other extreme as well.
Yeah, that's part of what balance is all about. I tend to like a low PE because it's much like a high jumper. In order to reach the goal as a high jumper, that PE is the height of the bar. In order for some of these companies to deliver the projected returns that are on the far right, they have to jump a pretty high bar. Whereas a company like MDC Holdings only has to have a PE of 8 in order to achieve that number there. I like that. So do I pay attention to the column? You bet your bippy.
It would be fair to say that it might help you break a tie, right, Mark?
Yeah, absolutely. Again, with that level of Olympic contest difficulty being, the high bar being a big part of that.
Yep.
All right, so let's go ahead and take a look at how this month's decisions would be made. I'm going to jump out of the PowerPoint and actually go to, if I can navigate around with my shrunken screen, I'm going to actually go to the dashboard. Going to the Manifest site, 99% of you are Manifest subscribers, so this won't be terribly new to you. If you're not, send me a note, and you'll get a test drive. You get all the functionality that you see here. I'm going to go into the 10 cup portfolio. This is the actual active dashboard. Let me see if I can shrink that just a tiny bit. So you can see that the dashboard that we just had up on the screen is right here in the center. You can see that, however, there is one small difference, that approximately $3,000 in cash has suddenly changed to $5,301. That is the infusion of the 401k contribution for the month. It happens to be a little over $2,100 is the maximum allowable amount in catch-up mode in a 401k today. So that has been added to the portfolio. So again, from top to bottom, and you can look at some of this kind of stuff as Ken was talking about. You can look at the high PEs if you want to put them all together. We always sort by the pars. But that's all there to see. Now, in terms of the overall portfolio, the weighted average projected return, the return forecast of the entire collection of stocks is about 11.5%. Right now, the average, it's actually a median, but the average on the 2,400 stocks that we cover at Manifest Investing is about 6.8. So we would be trying to keep our portfolio between 11.8 and not get too carried away, but we'd love to see it in that sweet spot. It's very hard to get it above that 11.8 if you're anybody out there managing a portfolio today. So we would like to see maybe take one of the stocks at the bottom, sell it, and replace it with a higher return stock, and end up with 11.4, greater than 11.4, hopefully closer to this 11.8 to 16.8, again, sweet spot target range for the portfolio. Okay?
And Mark, and to do that with that par number in the average list there, to do that without upsetting to any great degree any of the other values as well.
Yeah, and in fact, Ken often talks about the report card for the portfolio. Notice that the average quality is almost 90. That's exceptionally high quality. The growth rate, 12% is a great place to be. We like to see portfolios for people with risk tolerance and a long time horizon, 11 or 12%. I'm actually being pulled like the force of gravity a little bit higher based on some of the research into successful mutual funds lately. We'll be talking more and more about that as we go. It's got about a 1% yield, an A financial strength, and pretty consistent, stable earnings per share lines on the stock selection guides for these companies. In general, there's a couple exceptions, but in general, pretty good. So is that a passing report card, Ken?
Oh, it's very much a passing report card. And like I tell clubs that I visit, if your report card is pretty good, and this one is superb for a portfolio, especially in today's market, when you have a report card like that, one of the goals of your meeting is to just not mess this up by the time you leave the meeting. It's awful hard to mess up a really big portfolio, but it can be done if by aggressive selling, you can do it pretty quickly. So you do have to be a little bit careful.
Okay, I'm going to make one other pit stop before we actually dive into the worksheet for the portfolio, and I'm going to go to tonight's roundtable on the website. You can see that there's a couple of companies that are likely to be discussed this evening unless somebody changes their mind. But what I wanted to make everybody aware of is there's a series of screens here where I'm still scratching my head over exactly what company I would present. EPAM's already in the portfolio. I wouldn't invest in Facebook right now because I've read Life After Google. There's Google, speaking of Google. Axos, again, AX probably coming tonight. Some fairly interesting companies in that ivory soap screen. One of my personal favorites is RSI's less than 30, and there are not very many of them. I'm not finding a whole lot to be interested in here, but I always like to check. Again, these are screening results, people. I'm just looking to see, is there something here which captures my attention? I'm not diving into any one of these. Projected return on value, something we've talked about here a lot. Here are some of the higher projected return on value companies. This is the one that I would probably give the most weighting in a market like this right now. In fact, I will be looking between now and the roundtable at MDC Holdings and MHO because they both have fairly high projected returns on value. The average projected return on value right now is about 6 or 7%. So these are all very attractive. eHealth gets my attention a little bit. LGI Homes, one that's been in the roundtable before and could merit a return, but there's some very interesting companies on that list. The Hugh McManus screen, any of these close to their 52-week lows. Lo and behold, my recent choice of ReproMed Systems is actually down fairly close to its 52-week low. You may recall that Intel and Gilead were featured at the recent Successful Investing Conference, as was Global Cord Blood. Hugh keeps talking about BP, could just as easily substitute ExxonMobil in there. Len Douglas keeps sending us more stuff about that industry and how we may not be looking at it right. We need to really be thinking about that kind of stuff. What does Morningstar think is on sale for Black Friday or Cyber Monday? Some fairly interesting companies. There's some companies there that you have to hold your nose to even think about. Macerich, I believe, is in shopping mall. It's a REIT for shopping centers, I believe, if I'm right about that, Ken. And
Mark, it's a new name to me completely. I couldn't help you there.
So that, I mean, Morningstar thinks that's really heavily on sale. Well, there's probably a reason, and maybe Morningstar needs to do some catch up. But there's some interesting names on here, including several of the automotive companies, including our favorite automotive company here in this household, Fiat Chrysler.
I'm intrigued that the cannabis stock has made that list, Mark.
Yeah, it could be time to check that one out too. Now, you don't have to do any field research on that, Ken. Just some numerical research. He happens to live in the zone there.
Yeah.
In the medical zone, right? All right, so let's go back to the dashboard. So I was just kind of picking off some names there. I saw Intel, I liked eHealth, and I also liked a recent Pat Donnelly suggestion from the Successful Investing Conference. We'll throw those onto the dashboard just to demonstrate the capability. So we're going to go into the worksheet. Into the worksheet for 10 Cup, and I'm going to hit the reset button in case I had been doing any tinkering fairly recently. So now what we're in is a worksheet where we can play what-if games. what if? And in this case, what I'd like to do first, since we would like to see a little bit higher overall return forecast, is I'm going to sort this from lowest to highest and basically challenge these, at least in my head. The ones at the top of the list have the lowest return forecasts. And, would we think about selling some or all of these in an effort to raise the overall return forecast? Now, we don't have a lot of work to do here, and it's not urgent. This stuff is never urgent. You just take it, much like the cadence of a marching band, one step at a time until you begin to approach these levels. And we certainly have been selling a lot. You can read all about it at the site over the last several months. But what I'm seeing here is I have an emotional attachment to Gentex. Am I allowed to do that here, Ken? Is emotion allowed?
I don't know, Mark, but I think that comment about emergency bears a couple more words that I know a lot of clubs, a lot of people feel that they have to stay fully invested, but in a $3.5 billion in a $3.5 million portfolio, I think that a cash holdings of just over $5,000 really is fully invested. So there is no urgency to spend that money if you don't see something that's right in front of you that you can do. And if you have to make hard decisions, I think selling Gentex or Align, either one of them right now, is a fairly difficult decision to make. Although Align might have the tip in my mind because it's gone up so quickly, so fast again, and it carries that 48 PE into the future. But we are fully invested in the tin cup if we're really talking about dollars and cents.
Yeah, and in fact, Ken jumped over those first two high quality companies, and I'm going to confess I'm not that emotionally attached to Gentex. If it all added up and there was the quote unquote urgency, I would let that go in a heartbeat. In fact, we did reduce our position in a couple of these a few months ago. The one that kind of grabs me is SAP. We just added it to the portfolio recently at a price close to $100, and it's gone up, I believe, 20% in a month. It's a slightly lower quality company, but it's still a great company, formidable company. But what I wanted to show you guys, let me go back to where we've got it on the site. Just a month ago, we'll actually go and you can see the transactions that we're talking about here. But what I want you to see is just a month ago, we saw the addition of SAP based on a relative strength index was down around 15.2. That's one of those screamers that we've talked about a little bit here at the sessions. We thought of it as a poster child version of the economic pressures unfolding in Europe, and any turnaround at all is going to benefit companies like SAP. And in fact, I said, let's add it to the tin cup portfolio. It's special situations. That low RSI is hard to ignore. But if the stock price advances, we'll likely sell if the par approaches my par. How's that one, Ken?
It's a good call, and it makes logical sense. Again, I wish that we had 30,000 to invest rather than 3,000 or 5,000. But even raising some money by selling all or part of SAP would put us in a position to make us a reasonable investment then.
All right, so I'm going to get a little wild and crazy just for the purposes of the discussion. Let's celebrate S&P being up almost 20% in a month. And what I'm going to do is say, what if we sold SAP? So it's basically being put in purgatory down here in kind of a holding pattern. You'll notice that our cash is now 187,000. So we now have something to work with. So what I'll do now.
And you'll also notice, Mark, because this is really counterintuitive to a lot of people, you'll also notice the total par of the portfolio dropped to 11.1. And it dropped because the money went from SAP down to cash, and cash's par value is only 1.3. So the worksheet is handling all the arithmetic correctly for us, don't doubt the arithmetic going on in the worksheet.
Right, and that 1.3 might actually be a little bit generous. So what I'm going to go ahead, I said I kind of like eHealth. That would be EHT, excuse me, EHTH. I'm just going to throw it in the portfolio to see what it looks like. And it comes in the portfolio with no shares, but you can at least do a side-by-side comparison. You can see that it's a relatively high par. We don't like to mess with pars that are too far into the nosebleed or the caution section. This one might be a really great study. High growth rate, fairly modest PE, some fairly mid-range quality characteristics. So we'll just leave that one there. Let's go ahead, and because Intel kept showing up, and I believe either Si or Hugh picked it during the successful investing session, and you can see that Intel, if it were to be added to the portfolio, has a PE of 11, but a projected return somewhere on the low end of the buy zone, somewhere in that 12% on an annual rate. Very high quality company, again in a market where a little extra caution could be warranted. That might be a good addition to the portfolio. And then just for comparison purposes, I want to put Pat Donnelly's ASE technology in. And you can see that one checks in. Where did it actually go?
It's down there at the bottom, Mark.
Yeah, it's actually listed as Advanced Semi-Engineering. It's actually ASE technology now. I should probably change that name. But you can see decent quality, which is probably why it was attracted Pat's attention. Decent projected return, a little bit into the cautionary area, but with a high quality rating, we can tolerate a little bit of a nosebleed return forecast. So that's probably the one that I would like the most in this situation. And what I'm going to go ahead and do for this month, let me make sure I get the right company here. Oh, did I actually come out of the worksheet? I did.
Yes, you did.
Go back to the worksheet and hope that my work was saved, as it should be. Here's the Advanced Semi-Engineering. What I'm going to go ahead and do is buy a few shares of that one. You can see that our cash balance dropped down to $800, so we've spent most of the money available to us now. I like that one better than...
And check your new par now, Mark, too.
Yep, I'm going to go ahead and get Intel out of there. And it's just not time for Intel right now for this particular portfolio. It's a great idea for many portfolios, but what we're going to go with is the ASE, ticker symbol's ASX. And again, we'll take a look at the company to show you why I'm comfortable with it, other than Pat Donnelly bringing it up during the session a couple of weeks ago. But
Didn't you have another one in there, Mark, that you just added that you want to take out?
I think I got rid of the two.
Okay.
There's none with zero shares showing, but this stuff is all working out pretty good overall. So we've gone ahead, and what we have here now is basically a what if that could be presented as a before and after situation. What if we were to sell our SAP at tonight's quote unquote club meeting and add, basically take the proceeds from sale and invest them in ASX? And what would that do to the portfolio? Well, you can see that it's actually taken our median return forecast, the portfolio return forecast, and pushed it up to 12.1, which is in the sweet spot. And did not mess with the quality, kept all of the other characteristics okay, and actually raised our growth rate a little bit. So that's our transaction for December for the 10-cup portfolio. What you do at this point is you could basically come back to this and make no changes and come back to it and do other what-if situations. I'm going to actually save it to original, so that will now be displayed in the 10-cup portfolio on the website. Notice that all the changes have been made. The new company is in here. And the cash is back at $814. So again, that's how these decisions are made on a monthly basis using that worksheet. Any questions or comments, Ken?
Well, what I think is so fascinating, and it should be fascinating to anybody watching this, is the really relatively small amount of time that was spent coming up with a possibility and making the decision to put it into the portfolio. I mean, this didn't take days or weeks. This took, maybe even with all the other research that you had ready for us on prepared screens, maybe we're talking about 2 or 3 hours of concentrated looking for candidates and making a decision as to the 2 or 3 best to test on the worksheet.
Absolutely. So let's go ahead and return to presentation, give you a little bit closer look. This will be in the session notes, but you can see some of the stuff that was done there. And I did want to make this point that I saved the SAP chart. I also wanted to show that we were fortunate and bought at the bottom of this very large monthly decline. And again, under the premise that things will probably ultimately improve in Europe. And sure enough, you can see that the gain was, it wasn't quite 20%, but it was 15% or so. So good, clean fun. Just wanted to revisit some of the selections made because I think some of these are good ideas. Talk about a screen. These are still good ideas to rake over the coals today. Some of these names are very new. And you can see that ASE Semiconductor is right there. And it's already gone up 9% since it was presented 2 weeks ago by Mr. Donnelly. Of course, he's infamous for Stone Co.
Mark, we have a good comment from Carmen, and I think it bears talking about right now. She says, "Why is it you don't consider the tax implications of what you just did?" And Carmen, Tin Cup is a demonstration of a 401k and what you can do with money behind the tax screen. There are no tax implications for buying and selling in a 401k. The tax implications begin when you hit retirement and start to withdraw from that money. Probably you turn it into an IRA when you retire, and then you start to take minimum distributions from it at age, I think it's gone up to 71 and a half now. But the point is that for most of your life, while you're putting this 401k together, there are no tax implications for buying and selling.
It's a great question. The only thing I would add to that would be if you were in a cash or taxable account, the one thing that I strongly recommend that you do is that you actually figure out what dollars you're talking about. Because in the case of SAP, it would have been, we're not talking about $182,000. We're talking about a taxable amount of money, something closer to $10,000 or $15,000. And the tax on that for an effective tax rate around 20% is $2,000 or $3,000. So the $2,000 or $3,000 is really what you're debating. And the short version of a very long story is you never let that $2,000 or $3,000 get in the way if you're actually doing a prudent thing for the portfolio. You don't let the tax tail wag the dog because it can be most destructive. You can lose $2,000 or $3,000. Go ahead.
I also want to say that one thing that a lot of people may not consider is currently today, until December 31st, we know we are in the lowest tax rate we have been in for a long time. And when we have a new administration come in, we really don't know what our tax obligations will be for short-term, long-term gains, wealth tax, the whole 9 yards, because nothing has been there's a lot of information out there about that, but there's nothing's been officially passed. So also know what is going on within your state and what the government is talking about planning on doing with taxes in the future, so that you can make great decisions for yourself about those taxes. Because it took me a long time to recognize, like you said, Mark, of not worrying about, the dog shaking the tail, in that if I have to pay taxes, that's a good thing. Why? Because it means I've made money. So it took me a long time to recognize that.
Yeah, one of my goals is to pay more taxes every year, but I want it to be the minimum amount that I'm required to by law.
And we're getting comments from people in our audience, Mark, that says, well, what if it's in a non-tax deferred portfolio? Well, if it's in a non-tax deferred portfolio, Mark's already made the point that, first of all, don't look at gross numbers. Look at the actual numbers that will be taxed. Remember, you don't get taxed on the entire amount of the holding. You get taxed on the capital gain or the capital loss, and then whether it's short-term or long-term. I, at the risk of sounding really flip, I would suggest that if you have a $3 or $4 million after-tax portfolio, that taxes, while they make a difference, don't really have the implication that they might to somebody whose nest egg is only $100,000. I think Kim and Mark are both telling you good things. Don't let the tax man rule your investing decision. And we can all tell you tales of worrying about the tax man to the detriment of the investment, and then 6 months later not having to worry about anything because the capital gains were no longer there. So I'm at a loss to give a good answer, Mark, to a lot of these people that are saying, well, what do you do? I think it's individual. I think you each have to make your own decision. Maybe if you have that kind of a portfolio and those kind of transactions, you also need to come up with a pretty good accountant or tax lawyer as well.
Yep. Well, I'll tell you what, why don't we set aside some tax loss related topic for the next week or two, while there's still time in this year to pursue some of that. So that's the first thing we'll do. The second thing is 10 demerits for anybody who brings up Apple and the fact that we sold it earlier this year in a couple of our portfolios. All right, so here's a quick look at ASE Technology. The ticker symbol again is ASX, and this is a company that I don't believe it made our small company list. I'll have to look, but it certainly was a candidate. And Pat Donnelly brought it to the conference a couple of weeks ago, and I think we can all say that it's actually not that small of a company at $15 billion in sales, but it's actually fairly small relative to the herd that inhabits this area. And the area has to do with semiconductor manufacturing, testing, and all that kind of stuff. So the making of computer chips. Notice that the growth curve looks pretty good, and that as Pat pointed out during the session, there's actually been a bit of an uptick here lately. This certainly looks pretty healthy here lately, and they've been doing some fairly solid business. At the time Pat brought it to the conference, the stock price was actually down in the range. It's actually come up a little bit, but we're talking about a company growing at low double digits with decent net margins that are actually projected to probably return to or exceed those historical levels experienced a few years ago. PE ratio, again, somewhere in the 12 to 14 range, but decent PARs, very nice projected return on value for a company like this, and pretty prudent situation when it comes down to their debt capital too. What type of company are they? I actually think of them as Disclosure. Some of you may remember that movie with Demi Moore and Michael Douglas. Although the movie had a theme about a certain thing which we shall not discuss here. The sub-theme to the entire movie had to do with semiconductor manufacturing over in the Far East, and the need for cleanliness and adherence to specifications and all that kind of stuff. That's what these guys do. They basically make chips, manufacturing facilities for computer chips. It includes R&D. It includes the creation of new factories and plants around the globe, advanced technical support for next generation applications, smaller, faster, cooler, higher quality, all that kind of stuff. So I think of these guys as the disclosure company that are basically solving some of those mysteries. The interesting thing about the company, I think Pat may have talked about this during the session a couple of weeks ago, is a lot of this turbulence revolves around the loss of some clients in that time frame, that the company believes that were actually replaced with higher caliber clients. So they traded one person who needed computer chips made for them with other firms. And the result of that migration of business actually resulted in some technological enhancements and some improvements to some of their existing processes. So the loss of a couple of customers with the deferral to people who were already waiting in line and ended up being actually better clients to work with is an intriguing potential for this company. So it's a good study. So I would encourage taking a closer look at it. And now it's in Thin Cup, so we'll be watching it even more closely. Any comments?
I think it's okay. Yeah, Mark, I think it's okay to characterize this as a good, solid, medium-sized company. All the numbers, everything we're looking at seems to point to it being a medium-sized company, especially its growth rates kind of move us in that direction. And we've made the point many times that while you need those great small companies in your portfolio, up to half or more of your portfolio needs to be made up of these workhorses. And this is certainly the kind of company that I would point to and say, here's what I want to make up about the first half of my portfolio, companies just like this one with growth characteristics like this one as well.
Good stuff. So if I get lazy between now and 8:30 tonight, I'll bring this one back tonight.
All right.
All right, let's talk about, we've got just a few minutes. Let's talk about a couple of topics, and then we'll close with a book selection or whatever. This has to do with the monkeys tossing darts and beating the hedge fund stars and just outperforming the market. And it's a topic that's brought up a lot in the debates of active versus passive management. Where it simply goes, a group of monkeys throwing darts at ticker symbols often beats the experts. And it goes on more often than not. It comes to fruition. And a couple of weeks ago, I introduced you to Graham Stephan and showed you a presentation that he had made on some of the brokerage firms or whatever. This particular session, I'm going to recommend this one also. His thoughts on the 2020 stock market crash. Here's a spoiler alert. He doesn't expect a crash. No one does. No one knows. But he goes through and talks about all the catalysts that are in place and why you should be investing. And in his case, many cases, index funds with the sprinkling of Tesla and that kind of stuff. But I would recommend taking a look at it. But Ken, what I wanted to share with you and everybody else here is that he goes in and talks about this dart-tossing monkey phenomenon. First of all, he blames it on time-traveling monkeys that are very smart, and then he says, just kidding. So that's what those two are there. But lo and behold, what he blames it on, the fact that the monkeys do better so often. He says, just think about it. This is him talking now. Just think about it. You take the Russell 1000 companies, where you've got 1,000 companies from the biggest slowly growing companies to some of the faster growing smaller companies. And then you basically recognize the fact that of the top 20 or 30 companies of that 1,000 companies, that accounts for 40 or 50% of the market cap, or 40 or 50% of stock market performance. And then you dive in a little bit deeper and you find out some of these other 960 or 970 companies are smaller and generally generate higher rates of return. So Ken, guess what he backs up into as the explanation for why the monkeys win. Because
Well,
those
I think it's
darts.
something we've known for a long while. Yeah, it's something we've known for a long while. Yeah.
So I think he just called us a couple of monkeys.
All right.
I can live with that. Because basically what he has shown in his short dissertation is that, yeah, those 960 or 970 companies that are not the top 20 or 30 largest companies in the stock market are great places to find outsized returns. And again, it's just a reminder that that's the year-to-date performance of our 20 selections for this year. We missed it, Ken. We did not get that semiconductor company in the group this year. They'll be around for next year, maybe. It might have been a little bit too slow growing.
Well, I think also that the sales number might have disqualified it too, Mark. At 15 billion in sales,
Yeah,
I think that puts it squarely into the mid-size category.
yeah, and you weren't being very flexible on that this year, so.
Well, I was, but not from 1 billion to 15 billion.
All right, so there you have it. These are companies growing at 12% or more, and not 15 billion in sales, but we are up 20%, approximately 20% since Halloween, and beating the market now by about 5 or 6 percentage points at this point. So that's all I'm going to say. It's way too early and very vulnerable to a jinx. All right, here's a quick topic that I thought we'd kick around for a minute or two, kind of a lightning round thing that Len Douglas, in fact, Ken, if you might find Len and unmute him, Ken would like, or excuse me, Len would just simply like to observe that over the last several years, the Canadian, these are a little bit tough to see, but you've got Wells Fargo and some of the U.S. banks underperforming, and then Royal Bank of Canada, Toronto Dominion, the Bank of Nova Scotia, all outperforming both over the short term and the longer term, as shown on that stock charts series of charts there. And Len Douglas is basically asking the question, why is this happening? Any thoughts on this, Len? Is Len with us?
Len is with us, and he's unmuted, so go ahead, Len.
What are you thinking, Len?
What leaped out at me was, how come the Canadian money center banks, I found this doing one of the predefined screens on stockcharts.com for money center banks. Okay.
Mm-hmm.
Let's see how they're doing. And you look at the 200-day, which I believe is the left one. And my God, just about everybody was in the mud except for Toronto Dominion. Okay, well, let's go expand the time scale, and you get to the right one, and you say, "Oh my goodness!" How are the Canadians eating our lunch? And so that got me looking at it and diving into Value Line and running the industry analysis, reading through that, and then like everything else, trying a quick Google, and I did find a analysis on Seeking Alpha, but it's from 2016, and it's a very detailed analysis, and I haven't digested it all, but
well,
still.
I can offer one thing, and then Ken, you can take a shot at it. What I found when I've looked at this phenomenon in the past is I discovered, and just I'm speaking in a very broad generalization here, the Canadian banks are less frisky, and historically now. And for example, they had tighter mortgage requirements, and they didn't fall victim to some of the stuff that we were doing 10 years ago. So more conservative. In fact, back in that time frame, we used to compare the Canadian money center banks to a special breed of banks. The Value Line had set aside their own category called Midwest banks, because the banks on the coasts did not behave like the Midwest banks. And I think that the Canadian banks and the Midwest banks at least historically up till 10 years ago, were generally more conservative, less volatile. And I think some of that characteristic has persisted to this day. Look at the quality ratings for the Canadian banks. That's just a tribute to their consistency, compared to some of the others, some of the turbulence. Notice their projected return on value, which, by the way, the enterprise value for the calculation is the stock price plus the book value. It's not the same as an industrial company. We tried to solve the Greenblatt riddle with asset-based companies. So that's what that number represents. But notice how it's always been not flashy, but consistently relatively higher going over the years. So that's what I think some of that is reflected in how investors have thought about these companies. What are your thoughts, Ken?
Well, the first thing that comes to mind to me is that they're operating under a completely different set of bank regulations than our banks are working. I know that our banks have been constrained in the last number of years since the Great Recession in 2008-9. They'd been restrained with how much they have to reserve for loan loss, what their balances have to be, what they have to keep in reserve, to cover a lot of different things. And I think that maybe you can account for a lot of this with the fact that the regulations are so different. But I'm also wondering if the sheer number of Canadian banks plays to kind of a sieve which allows the successful to survive and those that are having issues to be absorbed. I think Kim made the point when she put Toronto Dominion into our last round table that there were only 8 money center banks in Canada. Kim, am I remembering that correctly?
I was thinking the number was 6, not 8.
Okay. Either way, it's an extremely small number. And are there regional banks in Canada like there are here?
There are, but I believe that generally what we are going through in the U.S. right now is consolidation. Canada has already gone through it. So you have small regional banks that are not surviving in the U.S. and they're getting bought up by bigger banks. And I think that's already happened in Canada. So that's why they have, the 6 big banks, 6 or 8, in case I would be wrong, but let's say they have 6 to 8 big banks, and they may have some small regional banks, but because you've done the consolidation, you're able to keep your costs much lower. You can be much more stringent on your lending measures, your loan loss revisions. You can have tighter metrics. So I think some of the Canadian banks have gone through what we're still going through.
Well, and you don't have to keep your eye on as many competitors either, when it's all said and done. So those are reasons just off the top of my head, Len, why this phenomena might be occurring. But it certainly is an interesting phenomena to think about a little bit and to understand. I do know that if you are going to invest in these, then you have to be prepared to pay some tax up front if taxes worry you. I do know that the dividends are taxed immediately before they even come to you as a shareholder.
Yeah, and that's the way I would think of them, Len, is they're just a little less flashy, and I almost think of them as the electric utilities of the banking environment. What electric utilities used to be. You could set your watch to them, and they just continually went up. So that's a first stab at the question. It's a good question. Thanks, Len.
Okay, one comment now. I haven't looked at all of them, but Toronto Dominion isn't limited to only Canada.
Right.
They apparently have all kinds of offices in the U.S. too.
Oh, down here in I'm in Fort Lauderdale. They're everywhere down here.
Yeah.
Because if you think about it, there's a lot of Canadians who travel down here, and Toronto Dominion has a tendency to be in those regional areas where they have high concentration of other Canadians, as well as it is a higher cost of living where you're at.
Yeah, and Bank of Montreal has quite a U.S. domestic presence also.
And it's expensive to live in Montreal.
You bet. All right. One last question before we throw a couple books out there for ideas. This is a question that came in, Ken. This has to do with the presentations during the Successful Investing 2 conference. A couple of you guys showed value line reports with the X'd out or blanked out section for annual rates. What's the reason? All right, so I took a shot at the answer, and this is the way I've always thought of it, because it is a mechanical calculation. Anytime you've got merger and acquisition activity, any additions or divestitures where the company on the left-hand side of the data array is not the same as the company on the right-hand side, it messes up the calculation. So that's my version. Anything you'd like to add to that, Ken?
Yeah, I'd add something that Cy stresses an awful lot about this box. He stresses that the box can give you information, but you have to use it as a knowledgeable person about the company. Notice in the upper left-hand corner, it says annual rates of change, and then it says per share. So if the company is doing a lot of share repurchase or share issuance for that matter, these percentages can flop around quite a bit and not be as indicative of what the core company might be doing or might have done in the past. So it's probably better to look at the projections that are coming in the data array, which is to the kind of the right of the value line sheet, rather than to use these other than maybe real gross indicators of sales growth and earnings growth going forward.
Fair enough. All right, reading can seriously damage your ignorance. Absolutely. We've been covering our favorite books here for the last several months. There's some really good ones on that list. Intelligent Investors have been named by at least 2, if not 3 of us. Stock Market Genius, One Up on Wall Street. Arnold Bernard's book from 1958, the guy who invented Value Line. Just some good stuff from top to bottom. And Kim wants to throw another one on the pile this week.
Well, as you can see, this slide is on the stock Air Products, and in their PowerPoint presentation on a quarterly report, they said that their management philosophy is creating shareholder value. And one of the things we've always been taught in BI is that we follow earnings. And I've always said, I learned that cash pays bills, earnings doesn't pay bills. So you want to make sure, as Buffett said in the part 2 of the SSG, is management. Management is a priority of importance. And if you don't have a CEO and CFO who are great capital allocators, and my personal reference in my checklist is at least greater than 10%, preferring 12 to 15. Ultimately, why have a stock? Because ultimately, if management is not growing the business however they are, but they're not allocating the capital to grow the business well, why do you want to own it? So capital allocation is the most important job of a CEO to get it to move forward. So one of the books I just finished is Dear Shareholder, the Best Executive Letters from Warren Buffett, Prem Watsa, and other CEOs. the bottom line is when you're reading your quarterly and annual reports, and we've all been told to go to the MD&A to find out what is management doing, and I like to say, is management walking the walk and talking the talk? So if they tell you they're going to grow the business by XYZ, and the next 2 or 3 quarters, are they telling you, I wanted to grow the business by A, and this is what we've done to grow it? And B, because we've recognized our stock price has retreated, we have bought back shares at a good price. C, we decided to expand into international markets, and our goal going forward will be B. So the bottom line is, I like to make sure I have companies within my portfolio that have great return on invested capital, and these letters will tell you if they do. And the big thing that everyone needs to recognize is what motivates ourselves as investors. And come on, guys, we do all this work for our portfolios. Why? Because we want good returns. Well, guess what? A CEO, CFO, they all want to get paid, and they would like to have their bonuses. So that's the other thing why I've made sure that I've said to people, always check the 14A, find out what the executive compensation is and what are the metrics that gets a management team to get their bonuses, because they know they got to meet these bonuses. If they're going to get paid, they got to meet the bonuses and find out, you know, is it fluff? Is it anything? Or is it something really financially driven? What, you know, are they increasing market share? Are their profit margins increasing? You know, because you want a company that's doing well, and if you've got a CEO, CFO, management team that knows what they have to do to get there, and you know what those guidelines are, then guess what? We're both going to make money. They will, and you will as an individual. And especially like it when management's got skin in the game, because if they don't have skin in the game, why? I really feel it's a real important thing for them to have ownership of shares of the company that they're running, so that they will benefit when the company does well. And if it doesn't do well, they won't be benefiting and getting bonuses. So I really have enjoyed this book. It's given me an ideas of a couple other stocks I need to add into my Pounce list or list that I have reference to. So I hope everyone else will enjoy it.
All right. Thanks, Kim. I'm going to go ahead and add Jim Clunan. Jim Clunan is the chairman and founder of the American Association of Individual Investors. The book is entitled Investing at Level 3. It's kind of a nerdy title of a bit. I kind of like the subtitle of the subtitle, Do Investors Look at Investment Risk Wrong? Many of you have heard Sai's presentations on volatility is not risk. But what kind of intrigued me with this whole thing is how many parallels there were to the last 80 years of the National Association of Investors, and some of the stuff we talk about the importance of smaller companies, how to behave as a long-term investor. He spends a lot of time talking about the extended market, much like the dart-tossing monkeys from a few minutes ago, and his targeting or objective mapping even resembles our 5% relative return ambition. So it's a good one to take a look at. There actually is a mini book report on the Manifest Investing Forum at that link if you want to dive in a little bit deeper. I would just recommend it. All right, here's your quick reminder that we will put this session on YouTube. The 5 sessions from the Successful Investing 2 conference, the COVID cancellation conference from a couple of weeks ago, are there for your viewing pleasure. This is an old slide. The counts are up much higher than that now. Just a reminder that if you'd like to be automatically added to this list, you can subscribe and you'll be notified anytime there's new content. And just a reminder that Successful Investing 2 conference is available also as a playlist, so you can access all 5 right there. And with that, I will just warm things up a bit, and we'll see many of you later tonight. And Ken, I will get moving on picking a stock for tonight.
Mark, are we going to stick around, Mark, to answer questions
I'll
after
stick
you?
around for a few minutes, but thanks everybody.
Okay.
I'll go ahead and stop the recording.